Hello everyone, today we are presenting the financial analysis of the KFC Holdings Malaysia Berhad. For this analysis, the dates of the annual report of the company are obtained in the year of 2009 to 2011. The introduction of the company: it is formed in Malaysia in the year 1973 and has developed its operations and has grown into a fully integrated food operator. KFC Holdings Malaysia Berhad, as known as KFCH, is a dominant position in Malaysia's strong, expanding retail food industry. Its operations, made up of two major internationally renowned fast food chains to enhance its product selling range of business activities, efficiencies and profitability. KFCH is involved in a highly profitable and fast-growing food and food processing business because they are the only integrated food operator. Also, KFCH was incorporated in Malaysia under the Companies Act, 1965 on the 22nd of December 1980 as a private limited company under the name of Bin Guam Holdings SDN BHD. The company adopted its present name on the 11th of July 1986 and was converted to a public company on the 13th of March 1987. The company was listed on the main board of the KLSE on the 11th of November 1980. The core business of KFCH are separated in two sections. The first one is integrated poultry, which means the company raises their chickens such as hatchery, breeder farms, contract broiler farms, feed mill, primary poultry processing in order to get the product to sell to generate income. And the second section is the ancillary operation. It means it provides necessary support to the operation of an organization such as bakery, commissary, sauce manufacturing, food service and catering, Food Institute of Malaysia and warehouse. The integrated poultry operations and ancillary operations are structured to enhance its product selling range of business activities, efficiencies and profit. As for the side business of the KFCH, KFCH is a subsidiary company under QSR brand BHD. QSR brand BHD acquired 32% of the KFCH shares. QSR Brands is the operator of KFC chain of restaurants in Malaysia, Singapore and Brunei. In the QSR brand they own 5 fast food operations. They are KFC, AYAMAS, Rasa Gourmet, Taste Buds and Pete. And now we are going to present the financial analysis from the year 2009 to 2011. Current ratio of KFC Holdings in 2009 is around 9 times, which is very high compared to industry average. This means KFC is not efficient for using current assets. Debt ratio is 7.77% and times interest earned ratio is around 21. Total asset turnover is 0.123 times, which is very low when compared to the industry average values. Operating profit margin is around 57%. Fixed payment coverage ratio is 4.8 and price earning ratio is 3.12. Sales and net working capital is 35.15%. Next is gross profit. The value is 1. Net profit margin is 94.64%, which is very high. Line purchasing is not proceeding by holding company. Earnings per shares is 16.4 and return on total assets is 11.7%. Return on equity is 12.68%, which is okay. Not bad, not good. Market book ratio is 4.48 and non-current asset turnover is 0. For 2010, current ratio is 5.7 times, lower than before but still higher than industry average. Debt ratio is around 5% and times interest earned ratio is 8.7. Total asset turnover is 0.08 times, still lower than industry average. And 2009, operating profit margin is 24.87% and fixed payment coverage ratio is 3.6. Price earning ratio is 3.44 and sales net working capital is around 30. For gross profit margin, it turns out to be as 1. For every $1 of sales, the company is able to generate $1 of the gross profit. Net profit margin turn out to be as 89.22%. Earnings per shares is 19.8. Return on total assets is 7.43% for every USD dollar of assets owned. The company is able to generate 7.43% of the returns of net profit to shareholders. Return on equity is 7.83%. It means every $1 of capital invested, the company can generate 7% of the returns to its shareholders. Market and book ratio is turned out to be 5.45 and non-current assets turned out to be a 0.1. In this slide, we would like to show how we got each ratios for KFC Holdings ratio analysis for 2011. For the first one is current ratio. The current ratio is 2.6 times. The company has 2.6 times of current assets to meet the requirement of its current liabilities. For debt ratio, the company acquired 15.34% of the debt ratio. Next is times interest earned ratio. The result is 17.85 for total asset turnover. It is 0.15 times. For every $1 worth the assets or uniqueness. Therefore the company can generate 0.15 times of sales. Operating profit margin is 70.47%, where the company can make 70.47% by operating the company. Fixed payment coverage ratio is shown as 1.5%. Price earnings ratios turn out to be 6.487, whereas sales and net working capital turns out to be 1. For gross profit margin, it turns out to be as 1. For every $1 of sales, the company is able to generate $1 of the gross profit. Net profit margin turned out to be as 83.04%. Earnings per share is 18.18. Return on total assets is 13.08% for every USD dollar of assets owned. The company is able to generate 13.08% of the returns of net profit to shareholders. Return on equity is 15.45%. It means every $1 of capital invested, the company can generate 15% of the returns to its shareholders. Market and book ratio is turned out to be 7.189 and non-current assets turned out to be a 0. Current ratio helps to measure a company's ability to pay short-term obligations. From 2009 to 2011, current ratio shows huge change. It decreased around 6 times compared from 2009 to 2011. According to the annual report, KFC is over-leveraged, so it leads to decreasing in current ratio. The other reason is that KFC might pay bills too quickly or collect debtors too slowly. KCF has less ability to pay short-term obligations, so it is not good result for KFC. For debt ratio, it measures the extent of a CONPANYS or consumer's leverage. It increased a lot in 2011 compared to 2009. This might be caused since more debt in relation to equity in KFC is being financed by creditors rather than by internal positive cash flow. Regarding to this analysis, KFC has more debts in 2011 compared to 2009. However, the debt ratio is still low compared to the other companies, so it indicates that the company has an opportunity to use leverage as a means of responsibly growing the business that it is not taking advantage of. Next ratio is times interest earned ratio. It shows how many times the company can cover its interest charges on a pre-tax basis. This ratio fallen huge between 2009 and 2010 but increased again in 2011. However, the final value is decreased compared to 2009 and 2010. This is caused of more vulnerable to increases in interest rates and less earnings are available to meet interest payments. So KFC has to pay up sales and increase ability to pay tax. Total asset turnover is an indicator of the efficiency with which a company is deploying its assets. This ratio increased since KFC improved efficiency of managers use the company assets to generate revenue. There is huge increase of revenue in 2011 compared to 2009 and 2010. In 2010 the revenue falls in huge value. According to analysis, operating profit margin is a measurement of what proportion of a company's revenue is left over after paying for variable costs of production. It increased a lot since KFC has low-cost operating model and it has good cost control and that sales are increasing faster than costs, which is the optimal situation for the company. Next is fixed payment coverage ratio, and it indicates a firm's ability to satisfy fixed financing expenses. According to calculation, it decreased because KFC has been less able to cover the interest on its debt and lease payments with its operating profit. KFC shows creditors and investors that the company can barely meet its monthly bills, so it has to be improved. Price-earning ratio shows company's current share price compared to its per-share earnings. It has decreased since people are willing to pay a higher price for the stock in anticipation of future performance of KFC. It tells the investors are expecting higher earnings growth in the future compares to 2009. Thus this is good signal for KFC. Sales net working capital measures how well a company is utilizing its working capital to support a given level of sales. This ratio increased since they earn more increase in sales and working capital. Thus, this might help KFC's operations run more smoothly. And gross profit margin measures company's manufacturing and distribution efficiency during the production process. This value is unchanged since there is no cost of goods sold through the company since it is holding company. Net profit margin is the key financial indicator used to assess the profitability of a company. Net profit margin is decreased since there is decrease in sales and net profit. This means FIC is less effective in converting revenue into actual profit. Its profitability is much higher than other companies since there is no cost of goods sold occurred through holding company. Earnings per share acts as an indicator of a company's profitability as well. It shows the portion of a company's profit allocated to each outstanding share of common stock. This ratio is increased since KFC is capable of generating a significant dividend for investors. This indicates KFC has potential worthwhile investments, depending on the market price of the stock. For return on total assets, it increased as well since KFC is earning more money on less investment. This ratio is an indicator of how effectively a company is at using its assets to generate earnings. Thus FIC successive manage the assets. In this slide, we are going to compare the ration analysis and changes that brought in KFC holdings. For return on equity, it decreased from 2009 to 2010. However, there are an increase from 2010 to 2011 about around 8%. Therefore, there is an increase in KFC, so it has its ability to generate profit without needing as much capital. For market/book ratio, if we see the slide, there are not much difference, but overall it has increased, so KFC has increased due to the differentiation based on market. As for non-current asset turnover, there are not much differences within 3 years. Therefore, it has decreased. The company has overvalued, which it leads the company's market value has to have exceeded its book value. The investing public has given the company as seen from the ration analysis above, the significant changes are in operating profit margin, where KFC has a low-cost operating model and there are huge differences between 2009-2011. Sales/net working capital, where in 2011, there are huge dramatic increase compared to 2009 and 2010. Last of all, seeing the significant changes in ratio. For return on equity, there is a decrease in 2010 compared to 2009 and 2011. And for debt ratio, if we compare all 3 years, there is a decrease in 2010 to 2009. However, there are huge increase in 2010 to 2011. To conclude, above ratios are the significant changes compared by different ratios. Conclusion. KLFC Holdings BHD Company was a prudent and well-managed corporation based on their financial performance and good balance sheet. The company was cash-rich in reserve. Moreover, the net borrowing was very healthy to finance business expansion, supply chains, resource training facilities, and productivity and quality management improvement programs. Most importantly, A fundamentally stellar financial performance had enabled the group to continue making major capital investments locally and overseas that will secure the future growth of the group for years to come. In addition, in just 3 years, 2009-2011, the KFC outlets had increased from 475 to more than 600 in Malaysia. Although all the group's business segments experienced inflationary pressures with higher food, commodity and energy costs, KFCH however had achieved Total revenue for 2011 had increased to a record high of RM2798.8 million, up 11% on the RM2522.4 million in 2010. Nonetheless, KFCH had also built a strong presence in Singapore and Brunei, and in 2011 had increased its network by 3 outlets in each country. But the biggest opportunities lied with the groups was ventured into India. The potential of the Indian market was tremendous. We would use our RM2.5 million investment capital to invest on KFCH stock, as it was a very solid and strong fundamental fast food corporation. The return on shareholders' equity was very impressive with good gross dividend per share. It was indeed a stable stock and versus stock exchange. The end. Thank you.